All right, we are live day 404 today. We're adding to our comparable sales list. So why are we doing this, right? We are adding to our list of properties that are being listed recently because I am staying on top of what's happening to the real estate market in this area. Now, if you understand what's going on with the market right now, I mean, interest rates are going up and down, right? But some of your biggest moves have already happened, right? So when and you got to understand the concept, right? The 10-year yield does this sort of slow dance, right? To take the analogy that I've learned from Logan Motoshami on Housing Wire, the interest rates on mortgage rates are really driven by the yield on the 10-year treasury. Now, when the 10-year treasury bond yield peaked, it was probably close to like almost 5% in the last 2 or 3 years. But at the same time, the spread between the 10-year yield and the 30-year mortgage rates usually have been about 1.5%, 2%, but they went to as high as 3%. So now that the spread has narrowed, you also have this fluctuation in 10-year yield. So as the 10-year yield go up and down, and I'll show you a little bit later, it has its effects on the selling price of homes because it affects your willingness to pay. And we're going to cover that a little bit. Okay. Now, 103 Beechwood Ave, all I'm doing right now is filtering on 4-bedroom homes, single family homes that has been less on a MLS or on the market for less than 7 days. So I love looking for 4-bedroom homes, and this property came up on 103 Beechwood Ave in Hueytown, 35023. Now, for 1512 square feet, I want to write down all these numbers out. 1512. This property was built in 1949. And the reason I want to note down some of these high level details is because, well, if you're pursuing the BRRRR strategy, which stands for buy, rehab, rent, refinance, and repeat, the whole point of the strategy is for it to be scalable. Okay. Now, what does that mean? What is the BRRRR strategy? So let's say you're able to buy a property for $40,000 and you spend $30,000 on a rehab. But at the end of it, you're able to force enough value, meaning you're appraised for, let's say, 100 grand. You just created $30,000 of equity, right? After only putting in $70,000 in cash, 40 grand of purchase plus 30 grand of rehab. Now, in that situation, it was 5 days ago, so it was 11/2. In that situation, you can now go get a loan for about 70% of the property's value. 70 to 80% is pretty common. And now you're able to get back out all $70,000 that you spent in cash in the form of loan proceeds. And that is not taxable because that is a loan. Again, I'm not a CPA. It's not investment advice. I'm not soliciting any investments on this call. Right? So when you do that, well, now what happens? You can take the same $70,000 and plow it into your next property. That is why this strategy is so advantageous and so popular, is because it allows you to scale a lot faster versus the traditional way of, hey, I worked full-time job, I saved the money for 20% down, and then I buy my property, then I got to save enough money for another 20% down, right? That allows you to scale a lot faster. That's why people really love that strategy. Okay, great. Now that we know why that strategy is so nice, well, all of a sudden, guess what? What is that strategy contingent upon? That strategy is heavily, heavily, heavily dependent on you getting your ARV, your after repair value, correct. Because after you renovate your property, one, how do you know how much you should spend on the property? And what should that renovated property even look like? And the only way you know is if you have some sense of comparable properties that you can figure out, hey, this is how I want my home to look. And this is in Hueytown, Avalon Park. Okay, this property, let's look at some conditions, because this property is listed for 123 square foot. You can kind of see other properties in here, like an okay condition home was listed for $77 a square foot. This property was listed for $133 a square foot. Maybe that 77 is simply because you don't see a premium once you go over a certain square footage. But this Hueytown, let's look at this property. This property could use some love. I mean, I don't know why it sold for such a high square footage. Let's look at this property. Beechwood. Beechwood looks like it has nicer finishings. It looks a little bit more modern with nicer floors and renovated like fresh paint all over, I would say this might be a better looking home. So if I want to renovate a property and it's a 4-bed and it's a 2-bath and similar square footage, I would say, hey, if I can renovate a property, I can be pretty comfortable with 123 a square foot as a rough estimate, assuming it sells for this price, right? That's your big if. That's your big what. Because this property is still for sale. It has not sold yet. Okay. But I'm seeing what's happening on a property, right? I'm seeing properties come onto the market at that dollar per square footage price. They might have listed it for $10 less a square foot because they're probably trying to beat out this property and make this property seem like a better deal, right? So many different, that's why comping is really an art, right? New paint, new flooring, renovated throughout, okay bathrooms, nice kitchen. I just try to make some notes to myself. The kitchen looks pretty, actually, wait, no, this is the kitchen. Okay, kitchen. Yeah, this kitchen is so solid. Okay bathrooms, above average kitchen, but not modern. Nice. Okay, awesome. Now, let me show you, now that I got this property in here, that's what I'm going to use for future properties that I see as 3-bedroom properties. And if I ever want to convert them to a 4-bedroom, I got to see whether or not it justifies the amount of money I'm spending on the after repair value on a dollar per square footage perspective. Okay. So now what I'm going to do next is I'm going to put in the details of this property at 103 Beechwood. It's listed for $186,500. The renovation on this property, I think, is pretty much turnkey. I mean, it looks nice. So I'll probably set aside $1,500 for the roof, just in case there's anything I can't see. $500 for some landscaping, just in case. Don't need to paint the home. Don't need to refinish the flooring. Don't need to repaint the cabinets. I might just replace 2 of the toilets with high pressure flush toilets so that I have less issues. And then I got a total rehab of $3,500. Great. That's going to come right here. I'm going to delete the ×2 because yesterday I doubled my rehab for a scenario. So my rehab is $3,500. Okay. Now I'm going to get my market rents. And I'm going to do this by going to affordablehousing.com, putting in the address, putting in the bedroom count, and you're going to see that my bedroom count, I mean, my average rent is $1,500, 1,500. I think that's a little high. I'm going to put 1,400 just in case, because that's what I've been seeing. But I'm going to do the scenario under 1,400 and 1,500. Okay. 1,400, because that's the average rent for 24 units within a 3.06 mile radius. Pretty wide radius. And then let me get my other expenses in here. My other expenses in here is going to be $56 for property taxes right here. And then $145 for insurance. So I'm going to equals 145 times 1.2. Since I'm adding a 20% premium by multiplying 1.2, I'm setting aside 10% of my rent every single month for maintenance, because I know that roof is going to get replaced at some point. I know that egg track is going to get replaced at some point. So please underwrite with this maintenance, because this money does not belong to you. Okay. All right. 10% for property management, 5% for vacancy expenses. And that's going to give me a net of negative 134. Assuming I can rent this property for $1,400, and also assuming I can get this property for 25% down. So my down payment is going to be $186,500 times my 25% down payment. That's going to equal to $46,625. My finance amount is going to equal to my B4, my asking price, minus my down payment in E19. So I'll be financing about $140,000 at 7.25%. That gives me a negative $134 of cash flow a month, which is a negative 2.9%. Negative 2.9. Now, what do we want to do? Let's do a couple scenarios. $3,500. Let's say I can get this property rent out for $1,500, which would be the best case scenario. At $1,500, even though I do nothing, but now you're doing a low sensitivity analysis, right? What would that do for your property? Well, you're still negative $59 a month. That's probably not what you would consider a deal, right? If you're losing money every single month. So let's go ahead and figure out what my willingness to pay is. How much do I need to lower my asking price in B4 to achieve a 10% cash on cash return in E9? Now, obviously, this is not investment advice again, right? But that's why you got to understand what and how might you look at this property. So at 118,000, this would be closer to 10%, but that's assuming you can rent out for $1,500. So 4-bedroom, $1,500 is the rent, right? That's how you're doing your sensitivity analysis. You're going to cash for $291 as evidence in B38. This is a 9.7% return, but you would have to buy this property for $118,000. Okay, assuming everything else stays constant with a $3,500 rehab, 25% down, 7.25% interest rate. Now, watch what happens if I say, hey, what happens when interest rates go down by 1.25%, so 6%. Well, now all of a sudden, my willingness to pay goes up because now, remember, the price I was using before was 118 grand to get about less than 10%. And now I can go up to $130,000 because that would be at 9.5. And that's what happens when you do your scenario analysis. You can figure out what happens to the housing market. In this scenario, right, your willingness to pay is dependent on your target return of 9.5 or 10%. That's very dependent on your own situation. That's why you got to consult with your own investment professionals. You got to understand what you're doing. Please, please, please talk to your own investment professionals because your investment goals and your strategy and your portfolio diversification is going to be very different from another person. Your goals might be different, right? Some people might just want to break even on $1 million property because they might be betting on 5% appreciation every single year, which would mean $50,000. So they might not care that they make $300 a year, right? Just be very mindful of that. So at 9.5%, you will be willing to pay 130 grand, which is $12,000 more than the last scenario because your interest rate dropped from 7.25 to 6%. And that's a narrow analysis I was telling you about that's your sensitivity. Your willingness to pay went up by 12 grand simply because in this scenario, your interest rates dropped 1.25%. Okay. So that's what I hope you take away from today, right? Because for every property, there's a price or set of terms that would make this a deal, quote unquote. So you guys, I want you guys to copy my homework, right? And that's the same deal I analyzed today using the same spreadsheet. You guys can go to affordablehousing.io. If you guys go there, you can go to the Get Deal Analysis tool, put your name, your email, your phone number. It's the fastest way you get a copy of the spreadsheet. I didn't make it from scratch. I got it from a few other folks. I modified it, I tweaked it, and that's how I'm able to analyze these deals so quick now. All right. So I hope you all have an amazing Thursday. I'll see you all tomorrow for day 405. Have a good one, everybody.